people are going to start to understand that blockchains are the coordination layer for the new digital economy. And that it's not, the fight about who's got the hardest money. It's not about any of that anymore. It's actually, this is the infrastructure layer for the digital economy. That's it. And once people understand that, you understand that this has a very large role to play in the future of the global economy, because it literally can't function without it. I know we first would say that, and now it's becoming really clear that it's the only way.
Crypto is going through one of its most paradoxical periods yet. Massive progress, but underwhelming price action. While Bitcoin continues to chop sideways and altcoins struggle to hold attention, capital keeps rotating aggressively into AI, semiconductors, and anything tied to the intelligence boom. On the surface, it looks like crypto has lost its narrative edge. Even the biggest crypto enthusiasts are beginning to question what comes next. But in today's video, we are going to show you how drastically the narrative is about to change. In a recent interview, Real Vision's Raoul Pal and Jamie Coutts argue that the market is starting to wake up to a much bigger idea, one that reframes crypto entirely. This isn't about hard money debates anymore. It's about infrastructure. Blockchains are becoming the coordination layer for the digital economy itself, and once that realization clicks, the implications for capital flows are massive. Pal makes it clear, the real shift hasn't fully hit markets yet. AI may be dominating headlines and absorbing liquidity right now, but that attention is temporary. What matters is where systems converge, and that's where crypto begins to reassert itself. Payments, AI agents, machine-to-machine economies, all early signals of a new financial architecture forming in real time. And that's the setup for this video. Crypto may have lagged in 2025, but 2026 could catch a lot of investors off guard. We're going to break down why liquidity still matters, why capital is being diverted, and why both Pal and Coutts believe crypto's role in the global economy is about to be repriced. If you want to understand where the next wave of capital could flow, and why, make sure you like the video, subscribe, and turn on notifications. Let's get into it.
The markets are sideways, choppy. Liquidity, by my measures, is growing, but not hyper-accelerating, while tech stocks are having a party. What's going on from your perspective?
Yeah, so look, global liquidity from my measurements too is also growing. I think we've just experienced a liquidity cycle that has been where global liquidity has grown slower than it has in previous cycles, but that should be expected because the last cycle was just the bazooka, right? Well, I don't think we'll ever see anything like that, or maybe we will, but it'll take something absolutely colossal to do it. Maybe
but don't forget, with that, Jamie, it didn't produce the highest returns either. And they're all nuances at each cycle. Like 2017, the US was actually tightening liquidity generally, while China and Europe were accelerating. They all seem to be different and they all produce different returns.
Yeah, I think about this a lot as well. We all fall into the trap of sort of sizing the current opportunity against previous cycles, and they all are very, very different. But obviously, you and I would agree that the biggest or the strongest correlation between asset returns is liquidity. If liquidity is growing generally, or if liquidity is growing and we're early in the liquidity cycle, that's when you generally capture the greatest returns. And as that liquidity cycle matures, even if liquidity is still expanding, generally it becomes a little bit harder. And we sort of go into these sort of 5-year refinancing cycles that drive the liquidity cycle, which also drive asset prices as well. So we've got to take that into consideration. And I also think, for a lot of people in crypto, the sizing of the last cycles versus this one has been problematic just because the competition for liquidity now is so fierce. Right, so the last cycle.
Because if you've got liquidity not exploding out of the gate, it has to somehow spread across all asset classes, and then even in crypto across all tokens. So without large liquidity, there is a competition, I guess.
Yeah, AI wasn't around in the last cycle. It burst on the scene, I would argue, through this current liquidity cycle in 2022, and it really, really ramped up in 2025. As the realization of the impact of AI on many different parts of the economy was starting to be, measured or factored into people's investment decisions. And so we had the scarcity, the AI related scarcity trade really ramp up in Q4, just as in the US, liquidity became excessively tight. So that was hard for crypto. And then you obviously had what happened with Binance. You had a confluence of things in Q4, which really undid.
And also China's liquidity, because China's been pumping liquidity the whole time, using the balance sheet because they have to. A lot of that flowed into gold. And that sucked out China's liquidity as the marginal liquidity driver. So there's always, people think it's a science. It is if you can break it down and look back and what moved it. But it's almost impossible to predict all of the levers moving at any one time.
I would agree. And let's talk about where we go to from here. So obviously, the internal dynamics of liquidity matter. We haven't really talked about the types of liquidity. I now sort of look at the past as being the QE era, and now we're in the central bank QE era, and we're now in the Treasury QE era. That mechanism of liquidity is still liquidity. It's still bullish. It's great for the business cycle, which you and Julian write about all the time and sort of own in terms of the framework that maps to the asset prices, or to the global growth or US growth and the asset prices as well. That mechanism of liquidity is also feeding through the banking system like it hasn't before. And I think that also changes how it's channeled into asset prices. Now, on face value, you can argue that is bad for crypto because it's going into productive use cases. And I think this is where the market, maybe in the next 12 months, is going to start to wake up to something. And that is that in the past, crypto or blockchains, let's talk about just the base layer. We both call it the substrate of the new digital economy. The substrate of the new digital economy was being driven by speculative forces. So it was never seen as a productive asset class. That is now changing because of what is happening with payments and what is happening with AI agents.
What stands out immediately is that both Pal and Coutts agree on the core driver. Liquidity is still expanding, but not explosively. And that distinction matters. In previous cycles, rapid liquidity injections created clean, aggressive moves across risk assets. This time, liquidity is growing more gradually, and that means capital has to compete across multiple fronts: stocks, AI, commodities, and crypto. The result is a fragmented market where crypto doesn't automatically dominate like it once did. Coutts leans into this competition dynamic, highlighting how AI has emerged as a powerful liquidity magnet, pulling capital away from crypto at a critical moment. Pal, however, reframes that as a temporary misallocation. As we move into the next phase of the cycle, he believes the market will begin to recognize that blockchains aren't just speculative assets, they're foundational infrastructure. And that shift in perception sets up the next phase of the discussion, where capital flows next, and why the current narrative dominance of AI might not last.
The probabilistic outcomes are quite complex right now, and we'll see. It'll clear up. Don't forget, we've got a war. We're in the middle of a war. After we had the government shut down, then we go straight into a war. We don't have a clean market. We've not had a clean market. What we've got is a very easy market to allocate capital in towards AI.
Yeah.
Because it's kind of immune to everything.
Very clear. Yeah. And so that's winning the narrative.
Yeah. And narrative is everything, really. It's how capital flows. It's whoever's got the strongest narrative gets the most amount of capital. If you also think about the VC cycle, look at the size of the raises for the latest A16Z crypto fund versus their other funds, right? I mean, the VCs are getting gigantic amounts of capital going into the intelligence part of the equation. Robotics, the biological stuff, the AI stuff, all of this stuff. But they're not raising as much money in crypto. And that often leads to increased opportunity, but it just shows where capital is flowing right now. It's like everybody's got one focus.
Yeah, look, I hear that data point, and that actually makes me a little bit more bullish. So what does crypto really need in terms of capital? Like, the base layer is essentially built. The networks that matter are scaling.
Yeah,
they don't need.
We don't need another layer one in any way, shape, or form. Layer twos are just commodity. They're just business pipes that plug into the layer one. A franchise, call it that. Call it a franchise business. or something built on top of Shopify. It's basically what it is, right? That's what a layer 2 is. Fine, that all applies. You can build your business on Amazon by selling products on Amazon. It's all the same thing, right? These are all network models. So we don't need any of that. We just need product market fit to scale. We've seen Hyperliquid, but that is really crypto native platform for now.
And without any VC as well. So that is your proof that, the VC capital cycle doesn't drive or shouldn't drive crypto any further.
Gun to your head, end of the year, higher or lower, or same?
I think it's Bitcoin can touch high 90s, but I think we go down from here in the short term. I think it's going to be a really bumpy year. And look, gun to my head, I think we make higher highs from here, but I don't think it's directionally going to go there immediately.
So you're just saying we can't have nice things. We're just going to have to watch the NASDAQ just going up, 20% every month as it's just gone up. And we just stand there looking at it thinking, why doesn't anybody love us anymore?
Not this year, Raoul, not this year.
This is a clear but interesting divergence between Pal and Coutts' analyses. Coutts remains grounded in liquidity mechanics and probabilistic outcomes. He sees a messy, non-linear market where multiple forces are competing at once. War, macro uncertainty, shifting liquidity channels, these all create friction. His outlook suggests that while crypto has upside, the path will be volatile, uneven, and heavily influenced by external capital rotations. Pal, on the other hand, zooms out, much further out. His argument isn't just about liquidity cycles, it's about structural inevitability. He's less concerned with short-term capital flows and more focused on where global systems are heading. And in his view, everything converges toward networks. In a recent tweet, Pal lays out what he calls a unifying framework behind economies, technology, and markets. He writes that the universe rewards whatever does more with less. Every system that survives is better at turning energy into information. He ties this to compression, how intelligence reduces complexity, coherence, how systems synchronize, and selection, how ideas and systems replicate and dominate. These aren't just abstract ideas. They describe how capital, technology, and networks evolve. And then he makes the connection explicit. What the four rules produce is networks, from biological systems to financial markets to the internet, and now blockchains. The same structure keeps emerging. According to Pal, this isn't coincidence. It's the underlying architecture of how complex systems scale and survive. And that's where crypto fits in, not as a trade, but as a necessary layer in this broader evolution. This perspective reinforces his earlier point. Blockchains are not competing with AI, they are complementary to it. AI processes intelligence, but it needs networks to coordinate, transact, and operate economically. That's where crypto comes in, and when markets fully price that relationship, capital doesn't just rotate back into crypto, it structurally reallocates. So what does this mean across timeframes? In the short term, expect volatility. Coutts is likely right. Liquidity isn't strong enough yet to drive a clean breakout, and competition from AI remains intense. In the midterm, as liquidity continues to expand and narratives begin to shift, crypto starts regaining attention, especially as real-world use cases scale. And in the long term, if Pal's framework holds, crypto becomes unavoidable infrastructure embedded in the core of the global digital economy. That's the real takeaway. This isn't about whether crypto is back this cycle. It's about whether the market has fully understood what crypto actually is. And if Pal and Coutts are right, that realization alone could be the catalyst that changes everything. So here's the question. Are we still early in recognizing crypto's role in the global economy, or has the market already priced it in, and we're overestimating what comes next? Drop your thoughts in the comments, I'll be reading through them. And if you found this breakdown valuable, make sure you like the video, subscribe, and turn on notifications so you don't miss what's coming next.